Welcome to TMS Insights. It's near the end of June. It's Jeremy Hook and Ben Clark bringing you an end of financial year update. You'll be receiving this at the start of a new financial year, so I guess we say Happy New Year to everybody. But to give you an update on what's going on, it's been a good period, Ben, the last couple of months in the market. But overall, the year has been really patchy. Yep. Most years are. We rarely get 4 good quarters. We had a very flat quarter in the September quarter. Yep. The December quarter was terrible for the market. It went down a lot. Great March quarter, yep. And this quarter right now is looking good. The year might end up somewhere in the 6 to 7% positive year for the ordinaries, which would be good. And I think a lot of clients might have done quite a bit better than that.
Yeah, look, it's it feels like it's been a better 12 months, but the feeling at the end of last year was horrible. So you're right, it's almost like the seasons in a year, and overall you'd sort of say that this has been a pretty standard year. This has been a pretty average year. So a lot of within the market, there's been a lot going on. So it's not like the market has risen all boats. There's been some places that are still out of favour, some places are white hot. So it's been very much about how your portfolio is positioned, and yeah, I think everyone's had a pretty good 12 months.
When we last spoke on the Insights, we had the election result. We knew that a rate cut was coming. That's been delivered. Another one's almost been banked in by Governor Lowe. Yep. But we have also seen a change in the APRA lending requirements, which all up gives a fair amount of stimulus to the economy.
Absolutely, yeah. I mean, we're now probably going to see one in July. I think there's a 72% chance of a third rate cut now this year. The bond market's priced in. So that's 3 rapid rate cuts. And the APRA changes are meaningful. I think the low in the Sydney housing market, I think, was about a month ago. And we've already seen some signs of some confidence coming back. So it's sort of difficult, Jeremy, and we've been speaking about this often, is that it doesn't feel that bad out there to have emergency cash rates, but the RBA is clearly trying to get ahead of something.
Yeah, that's right. And they know that they've got to be ahead of it to help. So, and that if they want to cushion the impacts of a slowdown, and they think that might be the case, they've got to start acting interest rate cuts.
Before you see the evidence.
It takes a long time to hit the real economy. So, but in the market, that's impacted on our portfolio. So we've had almost like a seesaw bend. There's an interest rate sensitive component, infrastructure, REITs, etc., where they rise enormously and have done that. They've been great. But there's other stocks that get really quite hurt by this slow interest rate environment. And in particular, what we're noticing, obviously, is people who've had cash and fixed interest are sort of finding out about shares for the first time as well.
Yeah, absolutely. I mean, if you look at the 5-year bond yield in Australia, is now at 1%. Now, there's 2 things I'd say about that. The first is that we've never seen a bond yield that low in Australia in history. The second thing is how quickly that's happened. So in December, the 5-year bond yield was 2.3%. So it's been the veracity of that fall in such a short period of time has been the other amazing thing, and this has pushed a lot of money, we suspect, out of safer assets like bonds and corporate debt.
The beginning of it, I think. It will keep going for a while.
I think so, yeah, because there will be a flow-on effect from this, as particularly I think amongst retail clients, as term deposits mature and people look at the rates that they can then lock in at.
So then bringing this into stocks now, of course, it's fair to say there's actually been quite a few downgrades, and across the economy we've found eclectic sort of stocks in different sectors that have been reporting that their profits may not live up to all the expectations. There's been some good news as well, but we've noticed a lot more downgrades, and we probably expect a few in July as well.
Yeah.
This is something I think clients should be understanding and ready for, because at times in the cycle you see a bit more of this, and in a portfolio it's going to happen.
Yeah, this is the unusual thing about this market at the moment, is that the earnings story actually feels to me it's not that great. You've got to bear in mind though, that's on the past 6 months, not going forward. But you look at the market trading nearly at an all-time high. I think that's largely been driven by the bond yields that we're talking about. But we've had 20 of the ASX 200 stocks have downgraded earnings in the last couple of months. That's quite significant. And the other thing I'd say there is normally you tend to see that in July. It's quite early in the season for a lot of companies to be downgrading, which sort of suggests there's more to come. So I guess having listened into a number of the calls, you really get the sense the economy ground to a halt in Australia in the last 6 months, probably around that election time, things sort of seized up, which is probably why you've seen the RBA getting on the front foot. And so, particularly with companies that have got a lot of exposure to the Australian economy, they're the ones that are sort of a bit more at risk. And but I think to an extent the market will look through it if things are starting to improve.
Yeah, I mean, there's definitely some of these companies get quite hit, obviously, after a downgrade.
Yeah.
Sometimes they have a downgrade cycle where it's 1, 2 or 3, and so these are things for people to be aware of, but not necessarily panicking into. And understanding some of the factors behind it. And I guess one stock that we should talk about, because we've spoken about it here before, and recently it disappointed us again since our last insights. Challenger has given an update, which wasn't what we wanted to hear, and they've been sold down a bit more. Yeah,
so they reaffirmed earnings guidance for the current year, but they've given a range of 500 to 550 million in profit for next year. Now the market was expecting a number around 560 million. So a couple of points I make there. The first is the market sort of priced this stock like they're going to come in right at the bottom of the range, and you'd hope after the announcement in December that the company's been conservative giving that guidance. But the other point I've sort of made to when speaking to clients is what is happening in bond markets is having a big impact on the Challenger business. Challenger largely funds the interest it pays on its annuity book through the bond market, and as bond yields have fallen, haven't been able to offer as attractive rates, and it's put their margins under pressure.
And the annuities themselves are less attractive going forward in that environment, so they're going to sell fewer. Lower margins, lower sales, so double impact there.
And the other, they've been a byproduct to the Royal Commission. They weren't involved in the Royal Commission. There was no sort of problems, but they've been sort of sideswiped by it in that the Royal Commission has forced a huge amount of movement in the financial planning market with advisors. And these ultimately are the sales force of Challenger, but at the moment they're doing a lot of compliance work or just trying to transition an entire client book from firm A to firm B, and not getting in front of clients and talking to them as you hope they are meant to be doing. So that's been an issue.
And on that yield comment, though, too, I think the point that we're making here is that the very good upside you've seen in some of the infrastructure stocks, for example, the airports, Transurban, etc., which have really had a massive run. That's the good side of the story. The challenge is copying a bit of the bad side. So in a portfolio, you look at that.
Yeah, absolutely.
And so when we look out to July, being the new financial year, it's a quieter period ahead of an August reporting season. New portfolios get positioned, new tax year and all of that sort of stuff. What are we thinking for the clients in the new year?
Well, I still, my preference is still you want to be skewed towards companies that can grow into offshore markets. And I think if anything, the news in the last few weeks continues to say that that's not a bad idea. Businesses, your CSLs and ResMeds and those sort of companies that are global businesses but listed on the Australian Stock Exchange, much less exposure to the Australian economy and still have enormous market potential.
And also, stocks which are truly listed on New York markets, and we are increasingly finding better value in terms of growth stocks listed in New York. And a lot of people don't know how to trade international stock, but it's actually rather easy. There is paperwork that needs to be signed to get that in place so that you can buy and sell, but the actual process is really almost as easy as buying Australian shares.
Yeah, definitely, and it's one area I bring up there that I'm sort of pretty keen on is particularly when you look at the technology businesses on the Australian Stock Exchange, and where after a pretty amazing year where the multiples they're now trading on versus what you can buy your Amazons and Googles, etc. at, the US ones look much more attractive now because they've really just gone sideways for a year in terms of their share price. Ours have taken off.
They're expensive,
And after our trip, I think one thing we did when we came back, particularly after sort of hearing that the world's greatest value investor has been buying Amazon shares, and Warren Buffett bought $1 billion of Amazon shares in the last quarter, is paying more attention to those companies and learning a bit more about them, and probably a lot more comfortable in sort of saying that they could be a good part of people's portfolios.
So if you do want to trade in the international and you haven't done it before, speak to your advisor and we'll be able to explain how we do it. Well, that's all we've got time for right now. We'll be updating you again in July.